Okay, everyone. Well, I'll tell you what. Let's go ahead and get rolling. I think we may have some other folks that may be joining us here in the coming minutes, but we'll certainly make sure we catch up with them later as needed. As a reminder, just from a housekeeping standpoint, as we typically do, we're recording the session today, and what we do is when we record the session, we then take the recording and we upload it to the archived training page at our website, and that's gone through a refresh here recently. So if you do have any interest in either this or any of the other presentations or training sessions we've got recorded up there, if you go to our website, of course, that's at the bottom left corner of the screen. You can see it there, advisorsib.com. If you go to our website and you go to tools and resources, you'll notice that one of the choices there is archived training and videos or something along those lines. And this session, when we're done with it today, it'll take us a day or two to get it kind of reformatted to upload there. And then we will most certainly go ahead and upload it to that site. So if you want to revisit it later on, if you heard something, but you want to hear it again, or maybe you want to share it with a friend, we certainly encourage that as well. Please do feel free to go ahead and do that. We've got the lines muted as we typically do, not any of our first rodeos, right? So we don't want to get any background noise in the middle of the webinar. So we do have the lines muted, but I put a little note in the chat there saying, hey, if you do have questions as I go throughout the presentation, you can go ahead and type those questions into the chat. And before we wrap up today, I'll take a look to make sure there aren't any outstanding questions as a result of what we go over today. So hopefully that works for each of you. Yeah, the session today is Life Insurance 101, as I'm affectionately calling it, with the subtitle of Why Life Insurance is Like a Pizza. And if it doesn't make sense to you already, which it wouldn't surprise me if it didn't, hopefully it will here in a few minutes. I want to use a pizza as an analogy for the ingredients that make up life insurance. And there are a couple of things that I'm hoping that you're going to take away from today, not the least of which is there are no right or wrong questions. There are not necessarily any right or wrong answers. And most important, as you'll see here momentarily, there is no one best kind of life insurance. I hear a lot of noise out there. You know, this person says everybody should have term. Nobody should ever buy permanent life insurance. This person over here says everybody should have an IUL and nothing different. If you don't know what IUL is, sit tight. We're going to talk a little bit more about that as well. The point there is that everybody's situation is different. And I hope to at least give you a foundation today where if you're not already familiar enough, or maybe as I said in the invite, you're out of the game for a little bit, maybe give you a foundation for how you might think through, well, just what solution or solutions might be best for my client in XYZ situation. So that's kind of the way that I've been looking at this. And what I want to do from a foundation setting standpoint is have us keep a couple of things in mind. And that is first and foremost, remember what we're doing here. We are doing everything we can as professionals to make sure that your clients and prospects, loved ones predominantly, are protected in the event something unfortunate happens to them. They die prematurely, for example. And so as a result of that, one of the things, and we don't have time to get into this in too much depth today, but there are some people out there who will say, well, geez, I've got 2 times my salary at work and my group term insurance, I'm all set. I think that and I hope that we will be able to make a case for the fact that having some level of personally owned life insurance is vitally important. Secondarily to that, having the right amount of coverage is certainly vitally important as well. The second thing is we got to keep in mind that people buy life insurance for different reasons. There's the pure protection aspect of it, which we'll certainly talk about, and is certainly a valid reason for that. But then they also buy for other reasons as well. It could be for cash accumulation. Now, that might be a little counterintuitive. You know, some people, I've heard the expression so many times, life insurance is a bad investment. Well, okay, there's a part of that that's true from the standpoint that you should no more buy life insurance as a pure investment than you should buy a pure investment as any kind of life insurance. They do different things. However, certain types of life insurance, and we'll talk about them, you have certain aspects that you can't ignore that lend themselves to an investment or at least an accumulation aspect to their overall financial picture. And we'll talk about why that could be important as well. And then finally, wealth transfer or legacy planning. Look, what are we essentially trying to do here? We have immediate needs that need to be taken care of in the event of our premature death. Then we've got some ongoing income replacement needs, perhaps. But then there's also that leveraging our estate when it goes to the next generation is that of interest to me. And vitally important with both of these is let's remember one key thing, and that is people are going to plan for whose reasons? Their reasons, not our reasons. So we want to try to be as objective as we conceivably can. Some of these might be or might not be interesting, but I ran across some stats on life insurance. I thought I'd share a few of them. They were kind of updated from the last ones that I looked at, because I had done this presentation, similar one to this, a little bit ago, and I looked, and it was actually 2 years ago that I did it, so it's been a while. And I noticed that LIMRA indicated that about 90 billion in death benefits was paid out. It's being paid out annually. It was paid out in 2025. That's a billion with a B, by the way, big number, certainly. 51% of American adults, that is, own some form of life insurance, and that could be individual or group. Now, think about that for a minute. That means almost half of the US population of adults do not have life insurance. So that should make you kind of put your finger to your temple and say, does that represent an opportunity for me? About 40% of adults, that's almost 100 million people out there, say they need more life insurance. They acknowledge the fact that, okay, maybe they've got some, but they probably should have more. Why aren't they buying? I think you could make the argument that there are few agents serving that middle market. More and more what we've seen, I got into the business in 1990, and I worked for one of the career agency life insurance companies. And when I was there were 17,000 agents with that company, I recall. Today, that same company, they still have some quasi-career agents, but there are about 1,500 of them. So we've seen this shift. There are some companies out there still doing a great job with the career agency distribution systems, of course, but there are far fewer of them. And that leaves this void or this vacuum that it's up to each of us to fill to make sure that people are adequately protected. And a lot of that falls to the middle market, because if there are fewer agents involved in having these conversations, where are they going to select to have the conversations? With the higher net worth individuals who perhaps can pay the bills better than the more moderate middle market. That to me also indicates there's tremendous opportunity there. So hopefully you agree with that conclusion. So why, if you don't already, why should you think about integrating life insurance into your practice? Well, if you're holding yourself out as a financial planner or financial advisor, I think very clearly integrating the protection conversation, and specifically life insurance, it's part of the overall financial planning vision, or the cores of the financial planning profession, which, as you'll see, has 5 components to it. If you're CFPs out there or you're active in financial planning, you know this stuff already. But risk management or insurance planning is a key component of financial planning. Yet too often it kind of gets cast to the side. So we need to be mindful of that and make sure that we're not ignoring that very important aspect of the overall cores of financial planning. Look, from a more selfish standpoint, you can build accretive or additional firm revenue. You're going to keep doing, if you're managing money and you've got AUM, or you have a fee-based practice, you're going to continue to do that business. This is an adjunct, a supplement, if you will, to that, and it's going to build additional revenue. Certainly anything we can do to sort of cement that client relationship is going to be helpful. And study after study after study indicates that having additional lines of business in a household is certainly going to help to cement that relationship. And from a more defensive standpoint, I would say that if you're not asking about it, guess what? Someone else is, or someone else will. And if that individual who's then asking, if they do what you do, if they manage money, do you run the risk of losing that client for their investment business, for example, because you didn't bring up the protection part of the planning puzzle? And so those are some things I would have you keep in mind. One other thing that we want to keep in mind here relative to life insurance, and that's where I want to go next with my analogy here, is regardless of the type of insurance, and we're going to talk about term, we're going to talk about whole life UL, IUL, we're going to talk about different types of policy. I want to suggest to you that the ingredients in life insurance are very much akin to a pepperoni pizza. And what do I mean by that? Well, there are 4 main ingredients in a pepperoni pizza. And if I were to ask you what they were, you would probably say, well, Bob, it's dough, it's sauce, it's cheese, and it's pepperoni. Okay. Now, let me ask you a question. If you changed any of those ingredients in that pizza, Would it change the flavor of that pizza? Well, the answer obviously is yes to that. So looked at a little bit different way, if we look at it in terms of life insurance and we think about the four ingredients in the pizza, what would be the four ingredients in life insurance? Well, I would suggest in a life insurance policy, first and foremost, you have mortality. Those are the actual charges that the insurance company has to collect to make sure that if somebody dies in a given year, that there are adequate funds there in reserves to be able to pay those death benefits. The next thing is expenses. They got to keep the lights on in the home office. They have to pay your commission to you, our override to us. They've got to pay other expenses that go along with issuing the policy, the paper that they're printed on. Sometimes more and more, they're going virtually with that. But all of that falls into the expense part of it. They're running a business, right? Just like you are or we are. The next thing is interest or investment return. Well, when a bunch of people take their life insurance premiums and send them to the life insurance company, they don't just stuff the money under the mattress, do they? No, they take that money and they invest it, and they get investment return or interest return depending on what it is in that portfolio that they're invested in, subject to obviously some regulatory limitations that are in place there. And then finally, lapses. And this is arguably related to expenses. But every insurance company, every life insurance actuary prices into the pricing of the policy an element of lapse that is built in to say, okay, how many people are going to keep these policies over a long period of time? Well, as you might imagine, it's a little easier to calculate that on a 20-year term policy than it is over, say, a whole life policy or a universal life policy, a more permanent policy that we'll talk about momentarily. So that becomes an issue if a lot more people keep their policies longer than was expected, because that means that ultimately more death benefits are going to be paid. That could throw the actuarials off and alter, pardon me, the taste of the pizza, that is the life insurance policy. And that's why we kind of term it under expenses, and vice versa. If people lapse policies sooner than we think, then maybe there's some expense expectation in return that the insurance carrier can expect. Okay, so why is it important? Well, look, those four ingredients, they impact a number of things going on in that life insurance policy, not the least of which is premiums. So as we experience as a life insurance company, different aspects of the mortality, expense, investment return or lapse components of things, it's going to change how we approach premiums. If it's a permanent insurance policy, that'll have an impact on cash values. If it's a whole life policy, as we'll see, we'll talk about dividends a little bit here momentarily, or it could be in the form of the interest return that is credited to the universal life policy. And then it also impacts the ability to guarantee premiums. In more recent years, we've seen a very popular type of universal life policy called GUL, or no lapse guarantee UL. It is a permanent life insurance policy and it's universal life, but the insurance company has calculated an amount of premium that if the client pays it each year, it's like term for the rest of my life. Now, those policy designs typically don't build up any cash value, but they can give the client that added security of knowing that, hey, I do want this coverage to last for the rest of my life, but maybe I'm not as worried about the cash accumulation part of it. Well, those ingredients in the pizza, if they change, they can have an impact on the pricing of those policies. Look at it this way. Look at it like, having the fulcrum in the middle and having those economic factors on one side of the seesaw and the policy performance on the other. Therefore, every action, there's an equal and opposite reaction. Isn't that the way the scientific axiom goes? Well, if we think of it, look at it this way. And if we kind of zero in on mortality, investment return, or expenses, if mortality goes up or mortality goes down, it's going to have an impact. If the interest or investment return goes up or down, it too will have an impact. And if expenses go up or down, they too will have an impact on the policy, right? Now, and we're looking at this a little bit linearly. There's nothing that says that these can't operate in tandem with one another too. You could have one going up, another going down, etc. But if we look at it like this, if mortality goes up, everything else being equal, premiums are going to go up. Why? Because the insurance is more expensive. Nowhere is that felt more obviously than with what type of life insurance? Term life, right? If mortality goes down, yeah, the opposite is true. Premiums will go down. If interest or investment return goes up, again, everything else holding equal, then generally speaking, premiums can go down because the company's earning more on those invested premiums than they thought they were going to earn. The converse is also true. If they don't make what they thought they were going to make, future premiums can go up as well. And as you might expect, same thing with expenses. If expenses go up, premiums have to go up. And if they go down, maybe premiums can actually go down. Looked at another way, when we think of the effects that these changes can have, same 6 changes, but if we look at it in terms of permanent life insurance, well, it'll have all of these things will have an impact on CSV, stands for cash surrender value. I hope you don't mind my acronyms. I'll point them out as I put them in here. But if I have mortality that goes up, it's going to have a negative impact on my cash surrender value. If it's a whole life policy that's earning dividends, it'll have an impact on the dividends that the insurance company decides to pay. The converse is also true as well. If mortality goes down, well, then my cash surrender and or my dividends may go up. Here we go again, an interest or investment return. If that goes up, well, my cash surrender value and or my dividends may go up. And if they go down, you see we're variations on a theme here, right? You can start to see how, thinking of that seesaw and the fulcrum in the middle, how these factors can contribute to changes in a policy as time goes by. All right. So using that as our foundation, let's take a look at some of the different types of life insurance that are out there. Now, for some of you, this is going to be a little basic, but I kind of laid that out there in the invite that maybe you're new to life insurance and maybe you're coming back after being away a while. So that's the context we're going for here. Okay. First type of life insurance is term, and the other type is what? Permanent. That's it. The 2 basic types of life insurance, it's either term or it's permanent. That's it. Now, as we look at each one, there are different subsets. So if we look at term insurance, we have something called ART, excuse me. We have something called ART, or annual renewable term. That basically means that each year, same amount of coverage, premiums go up. And it could be guaranteed for a certain period of time. Pardon me. And then we have level term. These are by far the more prominent ones that we see in the market. I could have 5 or 10 or 15, 20 or 30-year term even. Those are very common. Typically, the premiums are level and they remain guaranteed throughout the length of the term. Now, there is one type of coverage out there that you want to be aware of. It's a level term coverage, but it's something that's called select a term. Let me give you an example. Most people might automatically default to a 20-year term policy. Oh, I need some term coverage to cover my mortgage. Okay, here's a 20-year term. Okay, sounds good. Well, what if they only have 17 years left on their mortgage? Is there such a term product out there that could pay for 17 years, but still have a guaranteed premium for that level 17-year period? And the answer is yes. There are at least 1 or 2 carriers out there that have that product. And we've seen that fit nicely. I'll illustrate why that's important here momentarily. There used to be, and I say used to be, I'm not aware of a carrier that has this anymore, but there used to be some carriers that had decreasing term, which you paid a level amount of premium. It was a lower amount of premium. And each year the amount of coverage went down. Well, as you might imagine, that was coverage that was handy to offset things like, oh, a mortgage that was decreasing over time, other debt that was decreasing over time. Those products have become more and more difficult to price as time has gone by, so we really don't see them used as much anymore. Frankly, the cost effectiveness of the 15, 20, 30-year terms has been so attractive that decreasing term has very much taken a back seat. Let's take a look at this graphically. And if we want to see how they kind of look against one another, if we look at ART, and these are not actual premiums, I didn't run every one of these, but it'll be pretty representative of what you might see. So with ART, I've got X amount of coverage, and you'll see the premium starts out at about $100 for the first year, but then by year 10, it looks like it's up to about $275 a year. So it goes up each year as I get older, with the face amount remaining the same. And that can work, especially in shorter term instances. If I only need coverage for 3 or 5 or 7 years, sometimes ART can be a very cost-effective solution for that. The other solution to that potentially is 10-year level term. And that's what we're showing here in the green. And you can see that the premium remains level for the whole 10 years of the level term. Now, why would I do 10-year level over the ART? Well, the theory there and the reality there is that over 10 years, the aggregate amount of premium that I would pay for the 10 years of level term even though it's higher in the initial years, you can see what happens there. Starting in year 6 or 7, it switches over. And the amount of annual renewable term premium actually starts to exceed the 10-year level term premium. So the aggregate premium with the ART over 10 years actually becomes greater than 10 years of level term, even though those premiums are starting out higher. So once again, if I know I only need coverage for 3 or 4 or 5 years, maybe ART is the best way to go. But if I know I need it for 10 years, maybe 10-year level is the more cost-effective approach. And then I mentioned select a term. In the light green, you can see that the select a term goes for 8 years, but the annual premium, it's more than what the ART premium was in the early years, but it's less than the 10-year level. Why? Because I only have coverage for 8 years. So that's where the select a term can come in handy, is it can say, okay, you need coverage for that amount of years. We can save you some money in premium by not having to pay the higher premium for the 10-year level term because you only have an 8-year need. So that's where that can come in handy. Very useful product. So I don't think we'll get any argument from each other about whether term life is the cheapest alternative at any given point in time. If I look at term life, I need $500,000 of coverage, and I look at term and then I compare it to virtually any other permanent solution out there, that permanent solution is going to be 5 or 8 or 10 times more in premium than that term life is going to be. So term is least expensive out of the gate. However, what I think you're going to find is that that's not the case over time. And I think what we want to think about is knowing that if I have a need for coverage for an extended period of time, there is this whole concept of the difference between cost and value. In other words, does it make sense for me to pay more premium, perhaps a lot more premium, as long as cash flow supports it? If I can spend quite a bit more in premium today, knowing that I have equity I'm building in a permanent life insurance policy that will return to me a net out of pocket of 0 or less, is it not worth at least examining that? And I think the short answer is yes. So as we think of that in terms of the drawbacks potentially, pardon me, in terms of term insurance, it does become the most expensive over time. So let's say, for example, I could take out 20-year term thinking I only need it for 20 years, but then I get to year 20 or maybe even 19 and I say, ooh, holy cow, I actually want to keep this beyond the 20 years. I'm going to have to make a decision. And that is either A, I'm going to apply for a new policy, and I may or may not qualify for that medically. We don't get healthier typically over time. We get less healthy. So what if I can't qualify for a brand new policy at that point in time? Well, that could become problematic. And then if I can't qualify medically for a new policy, I may be able to keep my level term policy. And what would happen is the rates for the level term, if even the policy allowed me to do it, the renewal premiums from that point, they switch over to ART, annual renewable term typically, and they are extraordinarily expensive because the insurance company is intentionally pricing in the fact that the only people that are going to keep that are the ones who are not healthy enough to qualify for a new policy. So they're going to charge an arm and a leg. We rarely see people actually keep the renewal premiums in force after the level term premium. So obviously, what if the coverage expires before I do? That may not be advantageous to us, right? So that points us, at least in one way, to a disadvantage with term. And that is, well, do I want to rent my insurance or own my insurance? To use that analogy, there may be instances where I may want to own it. And by that, we mean build equity such that the net premium outlay, when I factor in the cash value performance later on, could be either 0 or better than 0 over time, as opposed to the pure premium outlay I'm paying for term insurance. Goes kind of beyond the scope of what we're going to get to today, but it will make sense. In the future, we're going to do a couple additional sessions. One, we'll talk about life insurance as an asset class, and that would lend a little bit more light to this, as will the session that we're going to do on term versus permanent, where we'll give you some tabular actual numbers to kind of demonstrate that point. Okay, let's talk about permanent. And the one that's been around the longest, been around for a couple hundred years now, is whole life. And we've all heard of that. And that can come in a couple of different fashions. It could be whole life with a lifetime period of paying premiums, or it could be what we call limited pay, which is essentially, well, I'm taking that lifetimes of premiums and I'm compressing it into a shorter time period. There are some 10 pay life policies out there. There are 20 pay life policies out there. There are life paid up at 65 policies out there. There are life paid up at 90. There are a lot of different variations there, but essentially they do the same thing. They're compressing what I would otherwise pay over my lifetime into that shorter time frame. And as you might imagine, each premium would be higher as a result of that compression. There are also, by the way, some blended policies that we see out there where you can blend in certain riders in a policy to keep the premiums lower on whole life than you might think. And then, of course, we have UL, Universal Life, and that takes really three main different forms: the fixed or traditional universal life that is very much interest sensitive. An interest rate gets credited based on what's prevailing in the interest rate market, and that's how the interest gets credited. One of the newer generations, and has become extremely popular for a number of reasons, is indexed UL. And we'll talk more about how that works here momentarily. There have been some bruises that indexed UL has taken here, especially lately. Maybe we'll touch on that a little bit. And then, of course, variable UL is available to those of you out there who do indeed have a securities license and are clearing their investment business through a broker dealer. You have variable UL available to you as well. And we do write that. So why do people buy permanent life? I think the first thing that we want to be aware of is that life insurance under Section 7702 is afforded certain tax advantages, the first of which is tax deferred growth. So as I build cash value in that permanent life insurance, I don't have to recognize it. I'm not going to get a 1099-R from the life insurance company saying, oh, you built up so much in cash value this year, you have to include it in your tax return or on your tax return. It doesn't happen. The other part, and perhaps more favorable than that still, is tax favored access. As long as I'm not creating something called a modified endowment contract, which is a mouthful, MEC for short, I can actually get at cash values in my permanent life insurance policy and not pay taxes on that, even if there is a bunch of gain in that life insurance policy. So again, that too goes a little bit beyond the scope of what we're going to talk about today. This is 101, right? But know that those two factors, the tax deferred ability and the tax favored access, can become very powerful within that permanent life insurance. The other thing to consider is really as part of that is, as I mentioned, when does term make sense? When does permanent make more sense? There's this crossover year, or what I mean by that is that point in time where if I have the option today to buy either term insurance and pay that much lower premium, or I can pay the permanent insurance and pay the much higher premium, where the equity, the cash value in the policy would actually make the net number a crossover point, make the permanent make more sense. It's generally between years 15 and 20. Your takeaway there is that if you only need coverage for 5 years, 10 years, even maybe up to 15 years, maybe permanent life is not the best option for that instance. But if I have a need for the coverage or a want for the coverage for at least 15 to 20 years, I think it's imperative that you look very closely at permanent as an option there. Again, presuming that the client's premium cash flow can support it. Because if the premium is that much higher, but I can't afford to pay it, well, it's kind of a moot point, isn't it? And then the last thing, and here I go with more acronyms, but IRRs stands for internal rates of return. And what I think you're going to find is that the internal rates of return with permanent life insurance, especially if you're doing something called overfunding, I'm going to come back to this in a minute, you will find that the internal rates of return in permanent life insurance over a long period of time, not in 10 years, but 15, 20 years and beyond, you'll see internal rates of return potentially of 3.5%, 4%, 4.5%, 5%, 5.5% or more. Now, that might not sound too sexy, but if you think of it, this is a very conservative potential asset allocation in that regard. And those returns that I just gave you were after-tax returns, meaning if I wanted to compare, say, a 4% super conservative return to what would I need as a taxable equivalent yield to match that, well, depending on my tax bracket, I might need to get 6.5% in order to match the performance on an after-tax basis of that life insurance policy. That can be really advantageous for your client. Whole life, properties of it, fixed guaranteed premiums and costs, generally speaking, unless we play around with some of the more newer riders that are there, a fixed and a guaranteed death benefit. The cash value in permanent comes through the form of both guaranteed cash value plus dividends. Generally, there is something called interest sensitive whole life, but when it comes to whole life, we don't see a lot of that. It's almost always dividend paying or par whole life, as we sometimes call it. Now, that guaranteed cash value, you can actually open up that whole life policy, and those guaranteed cash values are actually listed in the policy. You know what it's going to be each and every year. In addition to that, the policy could pay dividends, and that's where the total cash value from the policy is derived from. Okay. And then depending on what I do with those dividends, generally speaking, my net death benefit, even if I start with a $500,000 policy, because those dividends rather in the policy can, for example, they can buy PUAs, what we call paid up additions. They're little blocks of paid up additional insurance death benefit that can increase that $500,000 death benefit over time, providing arguably a hedge against inflation and what have you. And then there have been some newer riders that have come up in whole life, but those two are a little beyond the scope of today's discussion. Now, universal life, on the other hand, that provides for flexible premiums and flexible death benefits. Now, keep in mind, I mentioned whole life's been around for a couple hundred years. Universal life didn't come out until the late 70s. In fact, I think it was E.F. Hutton was the first company. They're not even around anymore as an insurance company or an investment firm, but they came up with universal life back in the mid to late 70s. And if you think back, those of us who are around then, what was going on in the interest rate environment? You were getting mortgages at 15 to 20%. You were getting 15% on your CD at the bank. There was this inflationary environment that had interest rates going really crazy. And so we had people were taking, there was this thing going on called, your fancy word of the day, disintermediation. People were taking money out of their whole life policies with dividends that did not change as often as the general interest rate environment. They were taking that money out of their whole life policies and they were putting it in the bank. So all this money was flowing out of the life insurance companies, and they got hurt on that because they had to liquidate certain assets that they otherwise didn't want to have to liquidate. Universal life gave the insurance companies the abilities to more frequently change the credited interest rate and avoid that kind of disintermediation. So it became very popular, especially in the 80s, in the early to mid and even into the late 80s. Cash value growth, once again, we once again want to avoid that thing called MEC, modified endowment contract, which can more easily happen in a universal life policy than a whole life policy, arguably. Okay, it's quicker to react to changes in the interest rate environment, which help the insurance companies hold on to those reserves and hold on to those cash values. Got to be careful because they're especially with what we call current assumption universal life or CAUL. If I don't put enough money into that policy, it's not going to be the same guarantee as I have with whole life. So I want to make sure that the policy is adequately funded. But I can also guarantee the premiums. I mentioned no lapse guarantee or GUL life insurance a couple of minutes ago. I can pay more in premium to make sure that I do guarantee those premiums as long as I pay them on time. So there are trade-offs there. If I know I'm going to overfund the policy, am I worried about paying that guaranteed no lapse premium? Well, maybe I'm not as worried about that. There's a cost to that, by the way. So if I'm the insurance company and I'm saying I have to guarantee that premium, I have to charge more in the mortality charges within the policy to compensate for that. And so that charge gets funneled out to the amount of premium the client has to pay. So there are trade-offs there. If I were to pay that same premium in a current assumption UL, the cash value performance in that current assumption UL would be much stronger because the cost of insurance, because the premium and the death benefit are not as guaranteed, are much lower. So there are trade-offs. And then we have this thing called option 1 and option 2 death benefit, which looks like this. Option 1 is the maroon line that you see there. Option 2 is the green line. And you'll notice with the green line, essentially the way the green line works in option 2 is as the cash value in the universal life increases, so too does the death benefit by an identical amount. With option 1, the maroon line, it's a level death benefit, which means that even though there's cash value building in the policy, my death benefit is not increasing until way later on. And I'll tell you why that happens here in a minute. Now, you might say, well, why would I do that? Why would I go with a level death benefit rather than an increasing death benefit? And it's because the cash value performance for the same premium, if I have an option one policy, the cash value is going to be stronger in that policy than it will be in the option two increasing death benefit. Why is that? Well, that's because the charges for the insurance in option two, they're going by the same amount of net death benefit. And so as a result of that, there is a higher insurance charge needed because that thing called net amount at risk. Net amount at risk is basically the difference between the cash value in a life policy and the death benefit. Well, if I have the level death benefit and I know that my cash value is increasing every year, but my death benefit is remaining the same, my net amount at risk is decreasing each year. Thus, my mortality charges are lower. Thus, my cash values are bigger. With the option two, because my net amount at risk remains the same, the insurance charges tend to be higher. Now, which one's better? There's not one that's better than the other. It's whatever the client needs, okay? So hope that makes sense. Now, looking at cash value, this is kind of the way cash value looks between the three most popular permanent life policies out there. The whole life on the left, as I mentioned, is comprised of some guaranteed cash value in maroon, and then the dark green is the dividends to get the total cash value. Universal life is just driven by a fixed interest rate return component. And then indexed UL, we'll talk more about that momentarily. On the right, that is determined by the return of whatever index or indices I've chosen to determine the crediting in that policy. Okay, so how do they credit interest? Typically with traditional UL, you've got a base rate and a current rate, and it might be 1 or 2% on the base rate, which is guaranteed. But then depending on what's currently going on in the interest rate environment, I'll get some excess interest rate to get to the total net of 4 or 5% or whatever the number is. With indexed UL, it's a little different. Typically, that base rate is going to be a little lower. Like here in New York State, it's 1%. In many of the states outside of New York, where you might be, could even be 0%. Every policy is different, by the way. But then the actual return credited is based on the performance of an index, typically throughout the year. The simplest one that we see used is the S&P 500. And the simplest method that we see is something called 1 year point to point. That means if the S&P 500 was at 1,000 on day one, and then 365 days later when I had my policy, it was at 1,100, that's a 10% return. And that's the return that could be credited to my policy. Now, this is where it gets a little more complex with IUL because they could have these things called caps and floors, okay? And the caps typically says that, okay, if the S&P does 10%, like I described, but we have a cap of 8, I'm only going to get 8. And you might say, well, why on earth would I buy that kind of a policy? And that's because, remember, we've got floors. We have a minimum that these policies will go to where you won't go below. And that's typically 0%. So if I want to have some downside risk protection where I don't lose money, but I want to have the opportunity to maybe do a little better than what a traditional fixed universal life might do, that's where the indexed UL can come in really handy and can actually do very well, especially if I'm overfunding it. The other piece, participation rates, again, we don't have time to get into the subtle nuances of indexed UL today. We want to stick to our timeline. I want to try to get you out of here as soon as possible, but we'll talk more about that maybe in a future session. There's a graphical example of how that works, by the way. And the reason I showed this slide is because think of it this way. If somebody lost 10% in the first year on an investment and they gained 10% in the next year, what was the average return on that? Well, the average return on that was 0, you could argue. However, if you look at the end of the second year, if I lost 10% and then I gained 10% the next year, I'd still be under 0. That's because if I lose 10% in the first year, in order to get back to 0, I have to get what? 11%. Indexed UL removes that aspect of things. Since I'm not going to go below 0, in terms of my return each year, I'm going to lock in that lower floor potentially to give myself a little better opportunity to hit that average. Again, you're not going to do as well as the pure S&P 500 because of the caps that I mentioned, or even variable universal life, which could arguably perform better. But if I'm conservative and I want that protection of that floor, that's where IUL can come in handy. This is just another way of looking at that. In the interest of time, I'm not going to really get into that. Let me take a minute because I mentioned the overfunding part of this. And this is where either universal life, pretty much in every form, or even some whole life policies that have some of those newer riders that I was mentioning, it'll actually allow us to add more premium than would otherwise be necessary in order to keep the policy going. Now, the question you might ask is, why would I want to put more than I need to into a life insurance policy? And certainly the first and foremost use of life insurance is to make sure that the client's death benefit need is being met. You can actually do that through a combination of the permanent insurance in the IUL, for example, and have maybe a term rider or a separate term policy to satisfy the entire death benefit that they need. What happens is, as I mentioned, though, we have favorable tax treatment in that life insurance. As long as I'm not creating that modified endowment, I get tax deferred tax deferred growth and tax free access. So that can come in handy as its use as an asset mechanism, an asset supplement, if you will, to the other work that I'm doing. The key to this is, why does it perform so well? Well, because that excess premium that I might put into that policy, there are no more mortality charges coming out of those excess premiums. It's going purely to the accumulation aspect of the life insurance policy because I'm not getting any more death benefit. I don't want any more death benefit. I want to use this as an asset allocation tool and overfund it in order to accomplish that. So it can be a very effective conservative asset allocation. Again, we'll talk more about that in a future session. The other thing that it'll do, again, is helping to do that will help mitigate some of the volatility. If I'm worried about investment volatility, taking money out of my IRA or other source when the market is down, I can maybe hold off on doing that and take money out of this policy later on and wait for the market to recover to take money out of that other source. We see that used on a somewhat regular basis. So as we start to wrap up, the obvious question becomes, and it was a loaded one, is which one is best? And as I said, it really does depend on the client situation. We write a lot of term insurance here at AIB, write it all day long, and we'll continue to for completely appropriate needs. However, there are many instances where permanent life insurance can be a suitable alternative for your client and should at least be examined. So as we wrap up, remember the pricing of the pizza, i.e. the life insurance policy, including term, all of these ingredients have an impact. Those ingredients, the mortality, the expenses, the investment return or interest, and lapses, they all play into the pricing as a rule, right? The last thing that I want to mention that plays into this, for those of you that are in the state of New York, as we are housed, regulatory changes can have a role in this too. Without digging into the weeds too much, we've had changes here in recent years where New York State DFS has made changes to its reserving requirements, or the amount of money that a life insurance company has to keep on hand to ensure that it can pay death benefits and cash surrender values later on. New York is very aggressive in terms of how much it requires insurance companies to reserve relative to other states. Well, it's another ingredient in the pizza, arguably under expenses or mortality, depending on how you look at it. So if I, in New York, have to reserve more money, well, everything else being equal, premium being the same, my policy is not going to perform quite as well as the same policy outside of New York. So those regulatory changes have an impact as well. And we talked about what are the things that are impacted. So in terms of next steps, what I would suggest to you, first and foremost, as we wrap up here, take a look at your book of business. How many people in your book of business do you actually have life insurance on? Now, in this day and age, most of you have databases and some systematic capability, and even more recently, some AI that can help you delve into, hey, which of my clients do not have life insurance? Integrate into your ongoing communication with your clients a policy review campaign. We have some tools I'll mention here again in a moment, but we have some tools that we can provide you where you can actually conduct those annual reviews or however periodically you want to do them to determine, hey, do you have the right amount and type of life insurance in place? You got a lot of clients out there that maybe they've got a life insurance policy bought 35 years ago when the kids were young and they had a big fat mortgage, neither of which they have relative to their home anymore. Well, do they have the same need for the same amount and the same type of life insurance anymore? How about long-term care planning? Does their current permanent life insurance policy, that whole life policy they got from the Prudential agent 35 years ago, does that policy have a long-term care benefit on it? Well, there's a lot of policies now that have long-term care or chronic illness benefits on them. Maybe one of those is a better fit these days. So it's worth having these reviews. Again, do they have the right amount, the right type? There's newer riders out there, the long-term care and chronic illness riders among them. And look, all of this is within the scope and concept of coordinating with all the rest of their financial planning. And we do have a life policy review system. We have templates that we can send you that you can use to fill out and gather information. We'll help you review in-force policies to determine, hey, does it make sense for my client to keep this or not? And that's what we're here for. So that's what I have for today. I know we went kind of quickly, went 45 minutes on the nose, I think. And again, this was a precursor. This was kind of set the foundation for some future sessions that we're going to do on, that overfunding, and can I use permanent life insurance as an asset class? Short answer, yes, by the way. How does it really compare when I'm looking at term insurance versus permanent? Where is that crossover point that we talked about? I'm going to do another session on that as well. So my contact information is there. Let me look really quick here to see if we had any questions in the chat box. And if not, I will let everybody go. Looks like no questions in the chat. So I am going to go ahead and cut everybody loose for today. Really appreciate everybody being with us. And once again, the recording was done, and we'll go ahead and load this up on our website so you can take a look at it here in the coming days. And if you have any questions after that, feel free to reach out. So thanks for being here, everybody. Have a great week. We'll be back with you here coming up with some newer webinars we got as we go throughout March and April. We've got some really good webinars, not only scheduled already. Our good friend John Gibbons from Mutual of Omaha is going to be doing 3 separate webinars on long-term care planning. We're lining some up with our friends from Nationwide to do something similar. So stay tuned for more on that. Have a great week, all. We'll talk to you soon. Take care.